Hey guys, it's Mrs. Invest. So I asked you guys on Twitter what videos you wanted to see from me, and you, the people, have spoken. You want to see a video on how to generate passive income using covered calls. This is a really exciting topic, but it's also can be a little bit complicated if you know nothing about covered calls. So my goal today is to break it down and make it super easy to understand. So if covered calls, if looking at option chains looks like calculus to you, hopefully by the end of this video, it's going to be a lot clearer. And much like a three-letter word that starts with S, it's really hard to learn covered calls by just someone explaining the theory to you. You either have to watch a real life example or learn yourself through trial and error. It's hard being a spy these days. Let's get right into everything you need to know about making money with covered calls. All right, first, let's go through a glossary of terms that are essential to understanding covered calls. And I'm going to use these terms throughout this video so that I don't have to explain what they mean every time I say them. Let's just get this glossary out of the way. So the first is strike price. This is the price that you will agree to sell your shares for. And it goes with expiry date, which is the date that you agree to sell your shares if they reach the strike price by that date. And these two together, the strike price and the expiry date combined, create a covered call contract. And a contract is an agreement for 100 shares and 100 shares only. Next is the term sell to open. And what that means is you, the writer of the covered call contracts, sells the contracts to someone who will buy it so that you can receive a premium, or therefore by writing this contract you receive a premium. And on the opposite side you have buy to close, where you, the once writer of the covered call contract, wants to buy that contract back, and in this case you have to pay in order to close or exit out of the contract to make it disappear like it never existed. And when you do this, you can either end up making money or losing money, but more on that later. And assignment means when your shares get called away from you because the contract that you wrote gets fulfilled. So if your shares get assigned, they will be taken away in batches of 100 depending on how many contracts you wrote against your shares. So here's a sample call contract that you can sell for Apple stock. If you actually own 100 shares of Apple stock, then this would be considered selling a covered call. So in this contract, the expiry date is April 29th, 2022, and the strike price is $185. So what this means is you, as the call writer, agree to sell 100 shares of Apple stock if it reaches $185 a share on the open market by the 29th of April, 2022. And if that is true, then you will be paid $1.22 per share. But remember, each contract is 100 shares, so that means you'll be paid $122 premium today per contract that you sell. And strike prices are always compared to where that stock is trading on the open market that day. So an out of the money contract is when your strike price is greater than what the stock is currently trading at on the open market. And in this case, it's less likely that your shares are going to be assigned because the stock has not actually yet reached that price on the open market. In contrast, an in-the-money contract is when the strike price is lower than what the stock is actually trading at today, and that means it's more likely that your shares are going to get assigned because the stock has already reached that price at this present day that you're looking at the contract. And in the middle, you have your at-the-money contract where the strike price is exactly equal to the market price. The TLDR of a covered call is when you, the writer of the call contract, sell the right to someone else, in other words, the buyer of that call contract, to sell them your shares in batches of 100 at a specific date and at a specific price. And for selling that right, you instantly receive a premium in cold hard cash today at this very moment. And you can take that premium and go to Costco half an hour after selling that contract and buy toilet paper and protein bars. It's money that you get in your account that day for selling that right to somebody else. And these premiums that you receive are a great source of passive income because after all, you don't have to do anything other than have at least 100 shares of the stock. And the more batches of 100 that you have, which is really possible for stocks like Apple, which we're going to talk about in a little bit, that have split a bunch of times, so you end up with hundreds and hundreds or thousands of shares that you can use to collect premiums by selling covered call contracts using those shares as collateral. But what's really important with covered calls is that you don't do stupid things, and if you can make sure to avoid using them in stupid scenarios, then you will probably make money. So that kind of brings me into the next point of let's talk about when to use covered calls where you'll be very likely to be successful, and when to absolutely avoid using covered calls where you are probably going to lose money if you use a covered call in these scenarios. So when do you use covered calls? Well, number one, make sure you actually own 100 shares of the stock per contract that you write. You guys cannot believe the number of people that write naked call contracts. In other words, covered means your ass is covered. It means you actually own those shares. So many times people will write these contracts because they just want to make the quick premium, but they don't actually own the shares, and then the stock runs up, and then they end up having to buy the stock in the open market higher than what the price is in their strike price, and then they end up upside down, caught with their pants down. Like, just don't do this. Don't be stupid. Make sure per contract you own 100 shares of that stock. The second thing is make sure you have a price in mind that you would be content and happy to sell those 100 shares for. This is totally subjective. It depends on, what you bought them for, how long you've been holding them, how quickly you need the money that's held up in those shares. There's a lot of factors and they're completely personal, but have a number in mind that if tomorrow you had to sell your shares and you got this price for them, you would be happy. You'd be like, okay, well, I am happy with this. I made a profit. I can't complain. Third is when long-term you are bullish on a stock. You think the stock is going to go up over the long term, but in the short time frame from today until when your contract expires, you sort of think that there's not going to be a whole lot going on. The stock is going to be trading sideways, maybe stagnating, consolidating, not really going anywhere. And when you're also content holding the stock over the long term, regardless of what happens with the share price in the short term. So if you write the call contract and the price goes down in the stock temporarily, you're kind of okay holding, everything's all right. You're not really desperate to sell at any given moment, and you don't really think the stock is going to be going up significantly or have a super big run in the short term. And finally, number 4 is boomer stocks or value stocks. These are stocks that are in really established companies that over time go up, but they go up quite slowly. They don't really have much volatility in price fluctuations day to day and week to week, and they're relatively stable, but they go up long term. And with covered calls, assignment of your shares is a real possibility. After all, you are the one writing the contract, and for some reason, people seem to think that assignment of your shares or getting your shares taken away from you in batches of 100 is a negative thing. And yes, it is a negative thing if you didn't want to lose those shares. But remember, when you wrote the contract, you got to pick the strike price or your exit price and exit date. And for writing that contract, you received a premium. So really, assignment should be seen as a positive outcome, not a negative outcome. So on the flip side, when should you not use covered calls? The first is when you don't want to lose your shares regardless of the premium, regardless of the strike price. If you do not want to part with your shares right now, you are taking a risk by selling covered calls. If you have, let's say, a batch of 1,000 shares of something that you do not want to lose those shares because you want to hold on to them for the long term, you think, the premium that you receive pales in comparison to the long-term bullish view you have on the stock, but you get a little greedy and you're like, well, if I pick a strike way out of the money, it'll expire worthless. I'll collect my premium. I just, get the cash. And then enough times of doing that, I promise you, your shares will get assigned and you will be sad, shocked, surprised, and you'll be another person talking about how covered calls suck and how options suck because your shares got called away from you, even though you were the one that wrote the contract to agree to sell your shares at that price at that date. You are in control of the contract. You write it. So if you are not happy with the terms of the contract, don't write it. Simple as that. Okay, number 2 is if you think that you have a really bullish view in the short term from the time that you write the contract to the expiry date, that you think the stock has, a lot of momentum going behind it, maybe they just had a really great earnings report, there's something great happening with the company, and you think the stock is going to run up a lot and run up to your strike price and past your strike price if your strike was out of the money, might not be a great idea to sell covered calls because it's very likely that the price of the stock could run past your strike and then you miss out on that potential upside of however far the stock runs past your strike price. And third, you shouldn't use covered calls with super volatile stocks. Now this one isn't like a hard and fast rule, it's just way more likely that you're going to screw up. And a lot of people have tweeted me asking me, you know, do you sell covered calls against your Tesla stock? Why not? And I always say no. And one of the reasons I don't is because Tesla is a super volatile stock. If we just look recently over the past like 2 weeks, we were at 700 2 or 3 weeks ago. I don't remember exactly the day, but it's a very short period of time. I'll put the chart up. And now we're at 1100 in such a short period of time. Like, who could have possibly expected that? And when you're dealing with a stock that can rise 30 to 40% in a matter of weeks, or fall 30 to 40% in a matter of weeks, it's just way harder to write these contracts, because you could end up caught with your pants down and ending up either having to sell for the strike and missing out on a ton of gains, or ending up with your shares assigned when you really thought they were way out of the money. So it's not that you can't do it, you're just more likely to end up in a situation that you don't want to be in, writing covered calls on super volatile stocks. So let's work through an example. Let's say, now put yourself in the shoes of this very lucky individual. And hopefully this will all make sense. So let's say you're an Apple investor, you have lived through a couple splits, and you own 600 shares of Apple stock at an average price of $115 per share. And you think, well, I'm happy holding my Apple stock if it goes down, but if it went up, I would also be pretty happy to sell it. And you decide that you'd be content to sell these shares at $185 per share. So instead of just waiting for the stock to hit $185, you decide to sell a covered call using these 600 shares that you own as collateral. So what you do is you sell a call picking your strike price of $185. This is an out of the money call because Apple today is trading at about $172, which means the strike price is higher than the market price. Today, at least. And you pick your expiry date of April 29th. You figure, if I can get this price of $185 by April 29th, I'd be a pretty happy camper. And since you have 600 shares, you're going to write 6 contracts. And you receive $2.26 premium for these shares, or $226 per contract. Multiplied by your 6 contracts, that's $1,356 of cold hard cash that gets deposited in your account today for selling these covered calls. And what you do with that is up to you. Personally, I would go to Taco Bell. So that's basically it. That's a covered call. Now, let's talk about the options and the possible outcomes of this scenario. So option A is on April 29th, Apple stock is trading less than $185 of your strike price. And what happens here is this contract expires out of the money. Nothing happens to you. You keep your shares, and in the process, from holding from the end of March to the end of April, you've received $1,356 as a premium that you can keep and go to Taco Bell. The next option is on April 29th, Apple is exactly at your strike price of $185. So your contract expires at the money, your shares get assigned, you lose your 600 shares of Apple, they get sold for $185. So $185 a share times 600 shares is $111,000. But on top of that, you also still have that premium of $1,356. So you've kind of done what you outlined in the contract. You sold your shares at the price you were happy for, and along the way you got a little extra bonus of the premium. And the last scenario is where Apple on April 29th is trading greater than $185 a share. So let's say it's trading at $190 a share. Well, the outcome here is the same as scenario B, which is your shares are going to get assigned, your 600 shares will get sold at $185, so you will make $111,000 on the sale of those shares, plus also keep the premium. So it's the exact same outcome as scenario B. The only difference here is you've missed out on that extra $5 of upside because the stock is trading on the open market higher than the strike price that you've outlined in this scenario. And a lot of people talk about this particular scenario as like a negative of covered calls, like, well, you can miss out on the run up, your strike price is lower. If it's lower on the day than what the stock is trading at, then you've missed out on that extra gain. But also you have to remember, like, in your mind, you had already decided that you were happy selling your Apple shares for $185. So had you not written the contract and you just were like waiting to sell the stock, wouldn't you have sold it at $185, or would you have like kept waiting for $190? So it's like too hard to say if it's like a negative that you missed out on that extra $5 per share, because you don't know, had the contract not been in place, whether you would have actually held till 190 or whether you would have just sold at 185 anyway. But through this contract, you've also collected that $1,356 premium. You know, the real beauty here of covered calls is when you are ready to sell a stock at a certain price, but you're also happy holding it longer if that contract doesn't fulfill and if the stock goes down. Because in this scenario, like, you literally can't lose. You just will end up selling the price you'll end up selling the stock for the price you want, and you'll collect premiums along the way. And if your contracts expire out of the money, then you just keep the premium and you can write a new contract and just keep holding the stock. And again, this is good for stocks that you are happy holding. Like, you don't want to be holding a stock that you hate and just writing covered calls on it until the stock goes to zero, because like eventually you're going to end up losing if the stock is worthless. But if it's a stock like Apple, and you know, I don't want to say Apple's a boomer stock, but you know, it's kind of getting into value territory. You know, it's going up nice and slow. It's not having those crazy swings anymore. And you know, if your contract doesn't fill, you just take the premium and you write a new contract. Like, this is a really low probability to lose scenario. And if you really weigh out your options of whatever stock you're looking at, whatever stock you're considering selling a call for, and you are smart about it by kind of working through these things that we've talked through in the video, it's very, very likely that you will be successful. I'm not going to say it's no risk, but you're very likely to win. And that's really the beauty of covered calls when you use them appropriately. So there's two main factors that affect the amount of premium that you're going to receive when you write these contracts. The first is how far out you are till expiry. So the farther, all else being equal, the farther out your contract is till expiry, the more premium that you're going to receive, because as time goes on, it's just given more time for the company to reach that price, assuming you're out of the money, to reach that price that you've chosen in your contract. So for example, you can see here how, given the same strike price and the same Apple stock, just having a farther out expiry date, you get paid way more premium per contract. And the second thing is, the more in the money your contract is, the higher the premium is you're going to receive. You can see here, with the same expiry date but a much lower strike price, you're going to get paid way more in premium. And again, that makes sense, because if the stock is trading at, you know, $100 today and your strike price is less than what it's trading at today, you know, it's pretty likely that your shares are going to get assigned on I almost said judgment day, but on expiry day, and therefore, because it's really likely that your shares are going to get assigned, you are going to be given a higher premium. So back to Apple. You know, if let's say you like your shares, but you would be okay parting with them, you know, you can sell a way out of the money call. So write a contract where the strike price is way higher than what the stock is currently trading at, but you know, you're going to get a lower premium for that, but it's less likely that your shares will get assigned. And on the other hand, if you're okay picking a strike price that's less way out of the money or closer to what the stock is trading at today, you know, you're more likely to get your shares assigned. But let's say you bought these shares way long ago, so even at that price you're still making a huge profit, then you can pick a strike price that's closer to what you think will realistically be reached by your expiry date, and you'll be able to sell the shares anyway for the price that you're happy with, but at the same time collect a pretty nice premium. So if you can see how this is all coming together, you know, if you're okay holding the stock for the long term, you believe the stock is going to go up, and you have a price that you are willing and happy to sell for, like, it's really a no-lose situation. I think that's it. I don't think there's really anything else to say. Let me know if you want to see like a tutorial on CIBC Investor's Edge, or I could do Questrade too, but I mostly use CIBC Investor's Edge for options. I could do like a tutorial video on how I enter the information to put the trade in, or I can kind of go through the option chains with you in another video, just let me know. I would be happy to do it. And of course, if there's any other video requests that you guys have, you can comment below or tweet me, and I'll try to make them happen. So I hope you guys have a great day and see you in the next one. Bye.